Okay, in this audio series we are going to look at spread risk and default intensity models. Now we know that for each kind of risk there is a reward attached, and whatever that reward is can be measured in many ways. In the world of credit risk, we are interested in measuring that reward in relative to risk-free rates. So when we talk about the spreads, they are the excess of the risk-free rate, and we could have various spread like yield spread, option adjusted spread, credit default spread. So default can be modeled with simple Bernoulli trials or more complicated models such as hazard models. The relationship between hazard rates, cumulative default probability and conditional default probability is something that the analyst should look at when he search for the right model. The credit spread is approximately equal to loss given default times the probability of default. This is the very basic equation that comes into play. So let's start with the first topic here, that's spread convention, and we need to understand the different types of spread that exist, compare them, and which spread to use when. So a credit spread represents the difference in yield between the security of interest, which could be a corporate bond or a municipal bond or any other bond like fixed instrument, and the reference security, typically a higher rated instrument. Most of the time this is treasury. If we are referencing with something for less than 1 year, we use LIBOR plus spread. If we are referencing something with a long term, we use 10-year US Treasury plus spread or whatever. So these two securities should have the same maturity. So the difference in yield represents the difference in risk premium, not the compensation for time value of money. As intuitive and attractive as this definition, unfortunately it can be interpreted in many different ways. So various spread measures include yield spread, that is Y2M risky bonds, Y2M benchmark government bonds. Then we have I spread, that is a linearly interpolated YTM on benchmark government bond. Then we have Z spread, basis point added to each spot rate on benchmark curve. Then we have asset swap spread, which is spread on floating leg of an asset swap on a bond. Then we have the CDS spread, that is market premium of CDS of the issuer bond. Then we have the option adjusted spread, which is the Z spread adjusted for optionality for embedded option, and if there is no option, then Z spread is equal to option adjusted spread. Then we have the discount margin, which is the fixed spread above current LIBOR needed to price the bond correctly. So many of them looks similar, and yield spread and I spread look similar. The difference being in the I spread, linearly interpolated YTM on benchmark government bond is used. So that was something new here, and the other new thing here is the discount margin, which is the fixed spread above the LIBOR needed to price bond correctly. So I told you we will use the LIBOR if we are pricing things for less than 1 year. So just remember that discount margin is that, and the terms like discount were often used there. The more common spread definitions, yield spread, I spread and Z spread, are more used in the market. So if a company, ABC company, and US Treasury rate are given to us, and the time to maturity is given to us, and suppose that be equal, the YTM is given to us, and if the yield curve is flat, we can calculate the yield spread, that is the difference of YTM between both of them. Only if the yield curve becomes up and down, then we have to move towards spot rate and things like that. If the yield curve is flat, then the interest rate spread, or the I spread would also be YTM, and we will take the average of the different years. So if one bond is 20 years, other is 18 years, we'll take their average. So that is the only difference between I spread. And Z spread is something that's continuously discounted based on various spot rates. Now if you remember the structure of yield curve, we have got various spot rates for various time duration. So the spot rates would be different at all times, and based on that we have to adjust now. Now let's understand what is spread 01. So if we recall from part 1, the dv01 is the dollar value of 1 basis point. The dv01 captures the dollar price change from 1 basis point change in current yield. Similar concept for credit spread known as dvcs. Here the potential change in bond price is estimated from 1 basis point change in Z spread. So specifically if the Z spread is shocked 0.5 basis up or 0.5 basis down, and the difference is computed. So we are now calculating things with the Z spread. If the current Z spread is 207 and the bond is priced at 92, we would consider 0.5 basis point to the spread. When the Z spread is increased by 0.5 basis point, then the Z spread would move up and down and the bond prices would move. Now the smaller the Z spread is, the larger effect on the bond price. The result of straightforward results are straight because the 1 basis point represents a larger shock, and the whole idea here is that the Z spread depends on the rating, the risk, the inherent profile. So that might change due to earning or rating, and what would happen if the Z spread change but interest rate don't change. So that's why this thing become important. And also we have to remember that the spread 01 is a convex graph. Then we have binomial distribution. So there is something called Bernoulli's trial, and it is an experiment or process where outcome can take only two values, success or failure, also known as binomial distribution. Success and failure are relative terms that denote that even if an event happen or it does not. The connection to our discussion is that firm does or does not default during a particular time period, and we define that time period where the firm will default with probability, and 1 minus that probability is that they are going to not default. Then the mean and variance of Bernoulli distribution is probability and 1 minus p. Now it is an important property of Bernoulli distribution that each trial is considered conditionally independent. That is, the probability of default in next period is independent from the previous period. Hence a firm has survived until current period, the probability of default is same. This memoryless property is exactly the same as studying of coin flips. For example, if you observe that the fair coin has landed on head 10 consecutive times, the best guess for another head is 50%. So don't confuse this concept with cumulative probability of default. So consider a firm with probability P of default each period. The likelihood of the firm surviving 8 period is 1 minus P to the power 8. We clearly see that as long as the firm has positive probability of default, it will eventually default in a sufficiently long period. Then we have the exponential distribution and Poisson distribution. The exponential distribution is often used to model waiting times, such as how long it takes for an employee to serve a customer or time taken by a company to default, and it's denoted by 1 by beta into e to the power x by beta and a negative sign. If you remember, even the normal functions are built up of exponential function in a specific way such that it should equal to 1, and its variance and standard deviation are 1, and so on and so forth. So ultimately we still use the same exponential kind of a thing. So the scale parameter here, beta, that is greater than 0, is the reciprocal of the rate lambda, and the rate parameter measures the guess at which event will occur. So in the context of waiting for a company to default, the rate parameter is known as hazard rate. And the hazard rate is indicative of the rate at which the company will default. Now this is very, if you remember the decay of a nucleus, and you can just go back and revise. It's an exponential kind of a thing again with the positive and negative variation. So that's some hint to check more information on this. Then we have exponential distribution is having a property that it is able to assess the time taken by a company to default. However, if you want to evaluate the total number of default over a specific period, as it turns out that the number of default up to a certain time follows a Poisson distribution with rate parameter T by B. So Poisson random variable refers to number of success per unit. The parameter lambda refers to average or expected number of success per unit. The mathematical expression for Poisson distribution is lambda to the power x e to the power minus lambda upon x factorial. We can further examine the relationship between exponential and Poisson distribution by considering mean and variance of both. The mean of the Poisson distribution and the variance of the Poisson distribution is lambda, and it turns out that the mean of exponential distribution and is 1 by lambda, and its variance is 1 by lambda square. So that was it. Now we move to the hazard rate, and the hazard rate are used to define probability function for default time and conditional default probabilities. The hazard rate are also known as default intensity, and they are represented by two parameters, parameter lambda and the probability of default over the next small interval dt. So lambda dt becomes our first part. Stated differently, the probability of defaulting between t plus dt is equal to lambda dt. It follows naturally that the probability of survival is 1 minus lambda dt. Now if we integrate this, and if the time of the default is denoted by t, then the cumulative default probability is represented by 1 minus e to the power lambda t. Now the equation calculates the cumulative probability of default, which is an unconditional default probability. Similarly, the survival probability is e to the power minus lambda t. Both default and survival probabilities sum to 1 at each point. In other words, if you have not defaulted by time t, then you have survived this point. As t increases, the cumulative default probability approaches 1 and the survival probability approaches 0. For completeness, we provide the marginal default probability or the default time density, which is a derivative of this equation, which is always denoted by capital Ft. So they use the convention in reliability as well as risk engineering that the capital is the main, and when we differentiate capital, you get small ft. So that is known as, the small ft is known as density, and it can be calculated by differentiating it, and it is a point in time figure. So it is evident that quantity is always positive, indicating that probability of default increases over time to intensity parameter lambda. Previously, the exponential function was used to model the default probability 0, t. If we examine the probability of default over t plus lambda t, given survival rate up to t, the function is conditional default probability. The instantaneous conditional default probability is lambda t. Now, given the hazard rate, we can calculate everything: cumulative probability, survival probability, conditional probability, and everything. So that's the only thing we need. So then we move to risk neutral hazard rates, and we need to understand risk neutral default rate from spread. So in structural models such as Merton model, the default probability are based on specific pricing function associated with firms' asset and liabilities In essence, the structural model implicitly assumes the modeler has much information about the firm as the firm's manager. On the other hand, reduced from model will take market price of liquid security such as credit default swap as fairly priced and back out the market aggregated expectation of default. To calculate risk neutral default rate from spread, we are interested in working with reduced from models which start with market observable spread. Yeah, this is something like the implied volatility kind of a thing, that you go to the market, you find out what's the spread trading, and based on that spread you find out the probability. Now for some people who want to buy or sell, they'll use Merton model or different model to find out the probability of spread. They'll use that to find out the credit default swap spread, and they'll trade credit default spread. We are doing just the opposite. So we are taking the credit default spread and we are reverse engineering from that the probability of default. So if we start a zero coupon corporate bond to maturity, match default free and government bond. So since the only cash flow at maturity, the current prices differ based on the yield. Specifically, the price of the default free maturing bond is P to the power minus risk continuous rate into T. Now if a price of a risky bond with spread relative to a default free bond has to be calculated. If no default occurs, the price between corporate and the default free bond at price converts to par at time t. In case of default occur, creditor will recover a fraction of par, which is the recovery rate denoted as RR. As a simplified assumption, suppose there is no recovery in the asset in default. Therefore, the corporate bond investor receives $1 if no default and $0 if default. On average, the expected value is calculated, which is the probability of default into 0 plus the probability of not defaulting into 1. Then we take out a present value of the term and we solve this equation to find out the risky bond. And solving for risk neutral hazard rate when the recovery rate is 0, and the interpretation of this analysis is credit spread is the hazard rate. So we introduce the positive recovery rate and the equation changes slightly. After solving for risk neutral hazard rate, we are left with one equation, that is lambda t is equal to zt upon 1 minus recovery rate. Stated differently, the loss given default is 1 minus recovery rate times the default rate, that is the hazard rate, approximately equal to the credit spread. So this is even if you did not understood what I talked about here, it's the same. Now if you are investing into a bond and you expect some higher return, and that higher return should be equal to the probability of default into recovery rate plus what you have invested in the treasury. So actually whatever you are asking more is nothing but a compensation that the bond is going to default, and you are asking higher than that. So you are actually indifferent between both of them. So if let's look a very simple case here. If the spread is 400 basis point and if you recover 20% recovery rate, then the hazard rate is 0.04 upon 1 minus 0.2, which is 0.05. So that's the hazard rate. So this is how we'll calculate the things. So the whole interpretation of this S analysis is that credit spread is nothing but the hazard rate. So that is the credit spread. So we now move to advantage of using CDS market to estimate hazard rate. Now the primary advantage of using CDS to estimate hazard rate is that CDS spread are observable, although we can create a model for hazard rate, the probability of default in the next on the surviving until current period. The estimated would inherently be guess. Instead we can draw logic reduced from model to use observable liquid CDS to infer the estimate of hazard rate. If the previous Analysis on estimating hazard rate did not fully capture the complexity of bond market. First, the published estimate of default probability are insufficient as they are typically provided over 1 year horizon, which does not match the duration analysis. Secondly, few corporation issue zero coupon bond. One can view commercial paper as de facto zero coupon bond, but the issuing universe is restricted largely and highly rated corporation. CDS can overcome these difficulties because they are liquid contracts and exist for several maturities. Further, a large number of liquid CDS are available, 800 in US market and 1200 in international market, and the contracts are more liquid than underlying cash bonds. Now, hazard rate curves is our next topic. So, before we move ahead, I'm going to revisit this hazard rate. Now, just assume one thing. If the corporate bond defaults, then what you are going to get? You are going to get the recovery part. So that you are going to get, and what you are going to lose is the 1 minus recovery rate. So the thing that you are going to lose is 1 minus recovery rate into the probability that this is going to happen, and this should exactly match with the spread, because the spread is the excess of treasury bond. So you can remember it like this, that the spread is equal to the default probability into the money that you are going to lose, and the probability is the hazard rate. So that's again one another way to look at the same thing. So we now move ahead to explain hazard rate curves and how a CDS spread can be used to derive hazard rate curves. Now this is interesting because the CDS rate is something that's already traded in the market. So in summary, if you want to use the probability of default of a company somewhere else, then you need these information to be reverse engineered from the market, and you can use them in your analysis. So that's where this hazard rate becomes very important. Now constructing the hazard rate curve using a bootstrapping methodology, not that different from bootstrapping yield curve. Moving from 1 coupon yield to a 0 coupon yield curve, the CDS spread provides several discrete maturity to extract hazard rate. We know that casual observation that CDS curves can take variety of shapes, so that constant hazard rate assumption from before is not likely to hold in practice. Technically, hazard rate are measured every instant in time, so that the CDS data will provide a few observable data points will require some form of interpolation or piecewise construction of the complete curve. Intuitively, hazard rate can vary over time. We can represent the time varying hazard rate as lambda t. When the hazard rate varies, probability of default becomes 1 minus e to the power integration of hazard rate. And for the special case, when the hazard rate is constant, then probability of default simplifies to 1 minus e to the power lambda t. For practical purpose, the hazard rate used in default models are not constant but will vary each time. Therefore, using CDS spread is reasonable compromise to accommodate changing hazard rate at discrete point in time. So using common CDS maturities, the time varying hazard rate function can be accessed in a general form, and 5 piecewise constant hazard rates are determined from the CDS spread. So we calculate all these hazard rates, and then we integrate them in the above probability of default for various intervals. So we'll just perform a simple integration of them such that the probability of default for each of these terms of 2 years we can get. So that probability of default is the probability of default in defaulting between those time period. So what this means is that we can actually infer from the market the probability of default for various time periods, and then we can add them up using a hazard rate and calculate the probability of default. So construction of hazard rate curve from CDS spread and default distribution from hazard rate curve is something very interesting. Now previously the hazard rate were extracted from default probability. This process relied on the simple data that present value of expected payment in default is equal to present value of expected premium paid. At CDS swap initiation, no cash transfer take place, but afterward there is a change in credit quality. So the protection seller gains while the protection buyer loses. The fact that CDS swap spread is observable allows for inherent of default probability maturity for 1 year, and thus given assumed recovery rate, which is usually 40%, the probability of defaults and as the hazard rate can be inferred. So the bootstrapping procedure is then employed so that the hazard rate for the first period is used to infer hazard rate from the second period from piecewise information, and using the observable information from the second CDS spread with third, and so on. So it's very similar to finding those forward rates. Now a graph can be constructed using the CDS spread, hazard rate and default density. The CDS spread single point, comma, the hazard rate solid line, and the default density, the dash point, and some conventions that are used in this kind of a graph. So what we see here is that the default curve estimation, everything comes down as the time processes. So the CDS spread, if it comes down with the time, the hazard rate and the default density and the default distribution increases, because of course with some time the probability of default increases when we sum up all those points. So now we look at how the default distribution is affected by sloping of the spread curve. So in order to explain how the slope of spread will affect the default distribution, it is useful to think the term structure of the CDS spread curve. As a benchmark consists of the impact of the spread, there are constant for all maturities, and that is market expectation of default is constant. In this case, the spread curve would be flat, implying that the probability of default in near term is same as the probability of default in long term. The most common spread curve is upward sloping. The aggregate market forecast that default is unlikely, but it increases with time. In contrast, spread curves, although unusual, may be downward sloping. This phenomena would indicate relatively high expectation of short-term default and distress, but the firm can right itself and it will survive for a sufficiently long period of time. Therefore, long-term spread are lower than short-term spread. The situation is similar to inverted yield curve, where short-term rates are extremely high but are expected to moderate in some time. On relative basis, a downward sloping spread curve has steeper default curve and upward sloping spread curve than the upward sloping spread curve, because cumulative default over short period is higher. So similarly, for intermediate and longer terms, the cumulative default distribution of downward sloping spread curve is flatter as the probability of default increases in short term. So even if the spread curve is moving up or down, the default probability increases, but it will increase at a fast or a slow rate. Then we have the spread risk as the last topic here. So spread risk is the risk that loss from the changes in the price of the securities that have a positive probability of default. By extension, the spread risk for treasury is zero for any maturity. Recall that initiation of CDS, the parties have implicitly agreed for a fair spread so that the expected payments to both are equal. Thus no cash trade hands of spread, rather the protection buyer is exposed at the narrowing of spread if the credit worthiness improve, as it is essentially agreed upon to now above the market premium. Naturally, a loss that is experienced by protection buyer that is a fee payer, represent a gain to the protection seller. Similarly, protection seller suffers when the spread widens, as it is agreed upon to provide contingent compensation in case of default at rate. To measure the spread risk, the mark-to-market of CDS and spread volatility can be used. The mark-to-market effect of spread by shocking the entire CDS curve up and down by 0.5 basis points, similar to spread 01. Note that slightly different from spread 01, where Z spread a single value was shocked. Thus the entire CDS curve moves up and down by parallel amount. An alternative measure of spread risk is to compute volatility or standard deviation of spread. This spread volatility can use historical data or can be forward looking based on subjective probability distribution. Not surprisingly, the spread volatility spiked extremely high during the recent financial crisis. So that was our whole story on the spread risk and default intensity models. And I'm just going to quickly revise on what we did again, so that if you have missed a lot of things, you can go back to it again. So the last point that we said, that the spread risk is the change in value of the risky security from changing spread. Similar to DV01 spread 01 calculation, the entire CDS is shocked up and down by 0.5 basis points to compute CDS mark to market value. Spread risk can also be measured using the historical or forward looking standard deviation of credit spread. Spread curves may be upward sloping or downward sloping, but decreasing default risk if it can survive the short term. Upward sloping spread generates cumulative default probability that are flatter in short term but steeper. Downward sloping spread curves are steeper in short term, as the near probability of default is higher, but in the future it flattens up. The default distribution can be constructed from hazard rate curve. The slope of the default distribution will be continuous to reflect the movement from one hazard rate to the next. The probability of default used to back out hazard rate for the first period, assuming the hazard rate is time varying. The process of repeated for next maturity via bootstrapping to estimate the next probability of default and hazard rate. This piecewise process is continued from several observable CDS maturities. So that was all regarding the spread risk. I hope this added something to your current knowledge base, and thank you for listening.